You're up 34% in 18 months. You did the research. You held when everyone else panicked. You bought the dip that everyone else was too scared to touch. And sitting there, looking at your portfolio, you feel it. That quiet, certain knowledge that you're just good at this. Better than average. Maybe a lot better. Here's what nobody tells you about that feeling. It's not confidence. It's not skill. It's a glitch. A very expensive, very convincing glitch in your brain. And the terrifying part? The better your recent returns, the deeper in you already are. Think back to the last time you made a call that worked. You bought something. It went up. And somewhere in the back of your mind, a small voice said, "I saw that coming. Not luck, not timing. You." So the next position, you size up a little. Because why wouldn't you? You've proven something to yourself. You start skipping the parts of your research that feel redundant. You already know how this ends. You've done this before. You check your portfolio more than you used to. Not because you're nervous, because you like what you see. You start having opinions at dinner parties. Strong ones. Delivered with the calm certainty of someone who's been there. And here's the thing. You're not entirely wrong. Some of your calls have been genuinely good. You did do the work. You did hold when it was hard. But something subtle has shifted, and you haven't noticed it yet. Your wins are getting bigger in your memory. Your losses. You've got explanations for those. The Fed surprised everyone. The CEO misled the market. Geopolitical noise, nobody could have seen that coming. The wins were skill. The losses were circumstance. Does that sound familiar? It should. What you've been experiencing has a name. It's called the Dunning-Kruger effect, but not the version most people describe where beginners think they're experts. That's only half the story. The more dangerous version hits people who are actually good. People who have some real wins, some real knowledge, but whose confidence outpaces their actual edge. And it's almost impossible to catch yourself in it because it feels like clarity. Here's what it's doing to your portfolio right now. When you attribute wins to skill, you take bigger positions next time. When you attribute losses to bad luck, you don't update your process. You keep betting on the same mental models that work without ever rigorously testing whether they actually did. And the market? The market is the greatest humbler ever built. It has destroyed more confident people than any other force in human history. In 2000, at the peak of the dot-com bubble, surveys showed that over 80% of individual investors believed they were beating the market. The actual number beating the market? Under 20%. 60 points of pure illusion, walking confidently into the wreckage. And these weren't stupid people. Many of them had been investing for years. Some had MBAs. Some managed money professionally. They just stopped questioning whether they were as good as they felt. The market didn't care about their confidence. The market never does. So here's what Buffett actually does. Not what he says in interviews, not the quotes on posters, what he structurally does. He assumes he's wrong, not performatively, not as a ritual, as a genuine operating principle built into every decision he makes. Before Berkshire makes a major investment, the question isn't, why will this work? The question is, what would have to be true for this to be completely wrong, and how likely is that? That inversion is everything. Most investors build a case for yes and then look for confirmation. Buffett builds a case for yes and then tries to destroy it. If it survives, it earns the position. If it doesn't, the file closes. Munger calls it inverting. He says the best way to solve a hard problem isn't to ask how to succeed. It's to ask how you'd guarantee failure and then avoid doing those things. The cognitive unlock isn't humility for its own sake. It's that genuine uncertainty seeking gives you better information than false confidence does. Overconfidence narrows your inputs. You stop hearing the counterargument. You stop reading the bear case. You stop updating. And then one morning the market tells you something your confidence didn't allow you to hear. One sentence. Commit it. Your returns are evidence. They are not proof. Here's the one thing to do today. Pull up your 3 biggest wins from the last 2 years. For each one, Write down 2 sentences. One sentence explaining why it worked, and one sentence explaining how someone smart could have predicted it wouldn't work. Not to talk yourself out of anything, just to practice hearing the other side. That's the muscle Buffett has been training his entire career. Not confidence, calibration. And if you want to go deeper into the biases quietly wiring your portfolio against you, next time, we're going inside confirmation bias. The way your brain literally filters out information that contradicts what you already believe. It's not a bug. It's a feature. A feature that will cost you.